afternoon. We're back from the break. Terrific. I'm Kimberly Johnson. I'm the Chief Operating Officer at Fannie Mae, and I am thrilled to introduce our final panel of the day, Harnessing Opportunity in a Changing Housing Market, a Venture Perspective. One of the most interesting parts of my role at Fannie Mae is my opportunity to oversee our technology strategy. And having an eye on strategy means keeping a really close look at what's happening today, but also having a view into what's happening ahead, sometimes years ahead. So today I hope our panel is going to help us look into our crystal ball and get just a little bit of a view into what lies ahead. We know that we have seen some really disruptive technologies transforming the housing ecosystem. And it's in building, it's the way that we sell and buy and rent and share houses. All of that is changing because of the technology that's available. Our venture investors have been anticipating that transformation in housing, and a lot of our startups are helping to make that a reality. So I am honored today to have a very select group of these change makers joining us on stage. First we have Baptiste. He is the co-founder and partner at Urban Us. That's a San Francisco venture firm that's focused on transportation, mobility, construction, and housing. Shawn is a partner at Moderne Ventures. That's a Chicago-based fund that targets technologies in real estate, mortgage, finance, and insurance. We have Chawla. He's a principal at Fifth Wall Ventures. He's an investor in technology solutions and commercial real estate markets. And lastly, I am going to introduce to you our moderator, Alesia Haas. She is the Chief Financial Officer at Coinbase, which is a San Francisco cryptocurrency exchange. Alesia also has a background as a CFO at One West Bank and Oxif. Please join me in welcoming our panel.
Thank you all for joining us this afternoon. So we're going to start off and discuss what are the most promising opportunities that each of you are seeing in housing and mortgage innovation today, focusing on disruptive trends and where you're putting your money. Where are you seeing capital opportunities in the space? So maybe, Vic, we can start with you and then move down the panel.
Yeah, absolutely. Thank you, Alesia. So we at Fifth Wall broadly look at all of the major subsectors of the real estate asset class, whether it's single-family housing, multifamily, commercial, hospitality, but specifically within single-family, we look at cost-saving opportunities on the home construction and financing side as probably the most interesting areas for venture investments. Broadly speaking, the real estate industry is the largest asset class on earth, but amongst the most inefficient. You still see mortgage origination costs by major players north of $8,000 for a number of what would normally be conventional type mortgages. And you see housing costs basically because of material and labor reaching really peak levels. And so I think from our perspective and then a number of the investments we've made have really focused on how do we give the consumer a better value proposition, both through better financing processes with businesses like Blend Labs, like Ethos Lending, and then on the construction and building side, businesses like Built Robotics and other in the modular space that can bring down the cost of the build.
Great.
Yeah, and I think we invest sort of in the same place. At Moderne, we take a little bit different tact, I think. So between our investor base, we cover over 50% of the residential transactions that happen. So that space is looking for us to find disruption and to get people in homes. I heard earlier, we talked about historically low home ownership. The other sort of part of our LP base is some of the largest multifamily owners and operators, and sort of the gateway to get renters into multifamily homes quickly without sort of the inhabitant of credit. We talked about the thin credit files earlier, so how do we help that process? And then really how do we move renters into homeowners and do that in a very seamless way and sort of help move that chain along of homeownership. So one of the things that we've looked at, or a lot of things that are coming down the pipe, there's this fractional ownership. I think is one of the things that we've talked about. So how do we have multiple parties that are buying homes together? I know Co-Buy was one of the ones that was here, and they're sort of helping do that. One of the things that we've seen recently too is this trend to sort of buy homes from an institutional perspective and then lease back to renters and to get them into homes quicker that way. And we're just sort of looking at a lot of broad trends and sort of how those really affect home ownership in the long term.
Thanks
great.
for having me. Urban Us is a venture fund that's motivated by one primary goal, which is to curb greenhouse gas emissions and increase do that by increasing the sustainability of cities. So housing is at the core of that. One of the biggest sectors of the economy, and in cities is where we live and how we spend our time there. Our energy use, our water usage, et cetera, all has an impact on the environment. And so I'd say one of the biggest trends that we're seeing is a movement, both from a policy perspective, but also from an individual motivation perspective towards sustainability. And that does ultimately translate to cost reduction, both in, when you are able to save energy or water usage, you're also lowering your energy or water bill. But also some of the other elements around how we live in cities, such as transportation and mobility, have both a direct impact on our carbon footprint and our cost of living, which impacts the overall dynamic around living costs. But the other thing that we pay a lot of attention to is how to increase good density in cities, make cities more livable, and so a big area that we've invested in is co-living. The idea that more and more people are comfortable with sharing some amenities, having smaller spaces, but in return getting more experiences and more community. And then finally, we're seeing a lot of innovation in the construction industry itself, making buildings more efficient and more efficiently. The area that maybe we differ between Moderne and Fifth Wall is we're not particularly looking at the transaction side or the conversion from rent to own. So that's Urban Us.
That's fascinating. So both you and Shawn touched on underlying consumer demographics, whether you're talking about fractional ownership or perhaps co-living. Can you expand more on those themes? And what do you see as the changing demographic behavior or changing customer behavior that may lead to new innovations in housing as we look at a future market versus what we may have experienced in the past?
Yeah, I think the way we look at it, consumer demand sort of drives a lot of business applications. So people are used to having this on demand for lots of other services. And so how does that happen in our space? And so we're seeing that push the envelope forward from a tech perspective, because we just talked about the last panel about how do you sort of push a button and get a mortgage. And I think Rocket Mortgage is sort of one of the things that sort of helped drive that from a consumer demand. So they want to figure out how to get in a home really quickly, and so I think the consumer demand has sort of definitely driven innovation in housing. Have you seen that as well?
We're seeing I'd say three things: shift in means, desires, and motivations. And so means in that, frankly, a lot of folks are leaving school with high debt cost burden. A lot of markets where the jobs are, prices are inflated, both if you want to be an owner and if you want to be a renter. So the options are shrinking for most folks. As far as desires, I think there is an increase, and this might be because of the means side of the equation, but there's an increased desire for experiences and access versus ownership. And I think that's shaping some of the decisions that folks are making. And then finally, motivation. Again, I think that folks are more and more paying attention to our relationship with the environment, the realities around shifting weather systems and climate, and are making more and more deliberate decisions around improving their individual footprint.
One of the difficulties that we specifically see, just to touch on their points, is venture capital isn't always the best type of capital for certain financing businesses because of the incentive misalignment. In the financing business, you want to grow slowly. You want to think thoughtfully about loss ratios. Ultimately, it's important to generate a business that doesn't accrue meaningful losses on your book. Otherwise, you end up out of business or out of compliance with sort of the various regulators that we have. And what you've seen in the non-bank lending markets or the financial service businesses that have IPO'd recently is there's this correction, if you will, from a technology company to a finance business. So I think from our perspective, what we're trying to be very thoughtful about is where can we make the most impact? Where can we invest in a business that will build out a good franchise, but also do good for the consumer and not sort of go through a meaningful correction when the financing markets change or lose to bigger competition like banks, which are also moving into fintech categories.
I think that's right. That's a nice dovetail. When you all think about making investment decisions, what are the factors that you're currently looking at? Are you looking at simple return on capital calculations? Are you looking at what is the problem that you're trying to solve? Are you looking at the largest addressable market? What leads you down a certain path and available opportunities?
Yeah, sure. So I think at Fifth Wall, we very much predicate our investing process on identifying businesses in which we can have a big impact. Yep. So our LP base represents some of the largest owners and managers of real estate in the United States, and now with our next fund will be global. And what we want to do is say, where can we give the consumer an amazing experience by leveraging the footprint of the real estate industry, adding technology, and then in massively solving a large problem. What's interesting about real estate is you usually don't have a TAM problem. The industry is so large and so backwards, we rarely have, this isn't a big enough market to go into. What's more difficult is what kind of business are we investing in and finding the right quality team. Mm-hmm. So to specifically answer your question, we break down our businesses into two flavors. One are the full stack end-to-end businesses where you go from the consumer or the business customer all the way down the value chain. The other are the technology retrofitting plays where you're bolting on a software on top of an existing business. And then those two businesses have sort of different underwriting profiles, which we look at uniquely so that we're making the right kind of bets for our limited partners where we can generate strong returns and create really big franchises.
Yeah, from a TAM perspective, we look at it a little bit differently because that's sort of the way that we're set up. And one of the things that we look at is the bigger the market, the bigger return for the investors. And so that's great in a real estate market. The TAM is big, but a lot of these companies are trying to solve a micro niche. And so when we look at these companies that are really insular to the business, that's not a big TAM. Even though the TAM of the market may be huge, they're trying to solve this really, either whether it's part of the transaction or the consumer experience, and you're really getting into this insular, type of product. When our view is, if you take companies that are solving horizontal challenges, and then you apply them to real estate, then you're going to have a bigger return. And the other thing you're going to do is, when the market cycles, and I've been in for 20 years, I was in secondary markets, in 2008, and stuff's going to happen, and we've been around for 10 years to say, we know that it's not if, but when, and we talked about sort of this ending. If you are very insular to this industry as a software company, as a startup, even if you are solving a niche issue, when the market turns and all your revenue is wrapped up in, you're not going to fare well. So try to find companies that are solving broad issues, and then make sure that there's applicability to real estate that does a couple things. That helps you from a revenue and a downturn standpoint, but also if we go to our LPs and say, here's solutions that everyone else is looking at, and there's great solutions all around, but if you're doing the same thing as everybody else, then you don't have a competitive differentiator. And when the market turns, you're really going to have a competitive differentiator. So if you're Century 21 versus Remax, you have to figure out, why does someone go to one versus the other? And if you're Greystar versus Avalon Bay, why does someone have you manage your building? So if you find things that are outside and you bring them to their doorstep and you say, these are the things that you don't know are coming, and these are companies that have just a broad base, they're going to be around to help you through those times.
Yeah, similar to what Shawn just shared, we're one of the ways that we frame what we look for in companies is we're looking for founders who want to reimagine city life. And so what that means is we're looking for fundamental new ways of thinking about the core sectors of city life, including housing and construction. And we're maybe investing earlier than Modern or Fifth Wall. We have an accelerator, Urban X, that we run with BMW, where we're sometimes meeting founders, when they have a very minimal prototype and just an idea. So we have to understand that the founders are the type of people that will be able to create something transformative out of nothing. And then another way we think about scale is this a problem that can be addressed in 100 cities or more within 5 years? Is this a solution that can grow that quickly? Because it is venture, and venture requires large TAM, but also quickness to scale because of the time windows of our return goals.
And a specific question for you. How do you factor in the access to transportation? And do all of you consider mobility as part of your investment thesis, or is that unique to the platform that you're sitting on today?
I can't speak for the panelists. I believe that that from what I've seen of Fifth Wall and Modern's portfolio, and they can speak for themselves, I think it's more and more understood that you can't tackle housing and real estate without thinking about the adjacent things, and transportation is the biggest adjacent thing. I mean, even real estate developers know that you can get higher rents or sale prices closer to transportation hubs, right? The closer you are to transportation hubs, because costs, it balances out the cost of living. Now, we look at things like last mile mobility as well, and again, we're working our way out from outward into housing, so we're motivated to solve transportation and mobility challenges for their own reasons. But there's definitely a bleed between the two, and more so as new innovations bear fruit, such as micromobility and what are the amenities that you offer to a resident, right? Do you offer a parking garage, or do you offer parking for their scooter? Yep. What do you do with parking lots if cars are driving themselves and parking more efficiently and need less parking lots? We have a company, Campsite, that's turning them into parks, private parks. And what do you do when the line between mobility and housing itself blurs, and you could theoretically live in a vehicle that's just as comfortable as a home and takes you where you need to go, or your office comes to you? So there's definitely a strong relationship that will continue to grow.
Yeah, I think the way that we're taking a look at it, we've got a couple companies, Envoy, which is multimodal electric for buildings. So we look at it from two ways: from a consumer, and that's a great amenity and a service to sort of help retain. But it also, from our developer perspective, is do you not have to build parking spaces anymore because this is part of the building and part of what we do? Or is the transit data that we have available to a developer where we can talk about land's cheaper away from the transit line, but are there the last mile options to get you there? So we're sort of looking at that broadly. Just because it's transportation and mobility, it affects where people build, how people get to work. And so that's certainly something that we focus on. I think we'll continue to probably focus on more. And I know we have some stuff pretty in common between us, our funds that way.
Yeah, no, we're very proud investors in Lime, and are excited to see them growing into what will likely be the largest e-mobility scooter business in the United States. What we were most, I think, interested in from the real estate perspective, to answer your question, was our fund was able to immediately foster relationships with large real estate owners to help with the rollout and the city level regulations. One thing I think all three of us see is engaging with the regulatory environment and engaging with city governments is core to what we do. So in the case of Lime, working with our multifamily anchors like Equity Residential, our retail anchors like Macerich, we're able to figure out ways to better deploy that scooter footprint in a way that worked for the city and for consumers, using the real estate presence that was already there. And I think we're going to continue to make those kinds of bets, because especially when you look at solving problems like congestion, e-mobility, bikes, scooters have tremendous promise.
I just want to take a break for a moment and note that we will be taking questions shortly. And so if you have any questions, please submit them to the address that you see up on the screen. To continue on the regulatory topic that you raised, Where do you see new investment opportunities, or where would you see new capital being attracted to the market if there were regulatory change? And if you could wave your magic wand and change a policy or impact local, state, national government, where do you see the policy change needed?
Yeah, no, we spent a lot of time looking at the regulatory environment. We're big believers to build great real estate tech businesses. You have to be compliant. There's just too much at stake. So if we were to wave our magic wand, I think what we would ask regulators to do would be to, one, create better engagement with early and medium stage businesses who want to be compliant. I can't tell you how many CEOs come to me and they're like, we're not even sure how many rules we're supposed to comply with. If we could engage with our regulatory bodies more frequently, we're trying to do the right thing. The rule book has just grown year after year as we have new regulatory bodies passing thoughtful rules for the time, but that rule book expands exponentially. So I think one is, can we get a better way for businesses here to engage with authorities to identify issues with their business or how they're thinking about changing it? And then I think second is, we have to be more rigorous about the prioritization of what we want to focus on. And what I mean by that is, it is absolutely fine to say, hey, we would like to support really high, well-paying jobs in the construction industry, but then you're going to run into issues with having widespread affordable housing because wages are an input into the cost of the asset. So we have to we have to prioritize where can we most effectively allocate resources, whether it's in supporting jobs at a particular wage level or it's in supporting widespread affordable housing. I see the weakness arise when you try to do both because you end up doing neither well. Where I see technology playing a role is, can we use technology to cut out all of the inefficiencies from an administrative perspective, et cetera, so we can try to do as much of both as possible. But I think when I engage with regulators, I always say, especially the ones in California, our fund is very committed to making sure that we're compliant with rules, we support affordable housing, but we have to remember what the cost inputs are as part of that if we want to solve the problem.
Yeah, I think that's probably...
Yeah, I would just add, specifically, I think an area where Fannie Mae and housing-focused regulatory-related bodies are playing. We see a lot of opportunity to introduce new ways of thinking about finance in the housing equation. Both, I know that Moderne and Fifth Wall have some investments in prefab construction, as we do. We're investors in blockable and in social construct, and the reality of the finance that's available for traditional construction versus prefab. There's still a very big delta there, and the theory around prefab being that you can control costs, you can overall lower the cost and time to get new housing stock out. And so I think there's still some room for, at a federal level, push towards making those type of those type of products, housing products, more financeable. But also, again, thinking about more dense living, not just in renting, but in co-purchasing. We have a federal policy and national pushes that have happened around, home ownership for individual families, but nothing like that for families that want to live together or buy together. So I think there's definitely room for financial innovation or regulatory innovation around finance. And then the other thing, more high level around finance, is that not only are the regulatory bodies growing and getting more confusing, but they're also fragmented. Housing is just one example, but from county to county or city to city, you'll have different things that you might run into. So I don't have an answer to that, but that's a big part of the challenge, right? And in some cases, a superseding body, like in California, where the ADU granny flat law was put in place to override what was a stagnant issue in a lot of the local regulatory entities, I think made a powerful statement around, at some point you have to recognize that there's an emergency. The housing crisis is really that. It's a crisis, and at some level, local interests need to be sort of reconsidered around what the broader interest is, the more future-thinking interests are. And again, don't have an answer to that. I certainly don't want the state dictating every single thing that happens at the city level, but there's certainly room for more flexibility around who's making what decisions when it comes to big challenges like the housing crisis.
Mm-hmm.
Yeah.
Shawn, do you have
Well,
anything
I
to
just think some of the regulations, we try not to get too involved in that, really help our companies navigate through what's there, because I think that's really where our expertise is sort of helping them is sort of helping them around how to function within those regulations. I mean, I think the regulations have stifled tech a bit if you think about it, and also from I know there's sort of the big Prop 10 that just was here in California, and sort of how that affects and whether you're on which side of that, but really how does that affect development? And it doesn't matter which side that you're on with the rent control, but is that how do we sort of help our LPs who a lot are developers, again, get in areas where maybe regulations aren't hindering that, because that's gonna hinder supply, and then trying to help our companies really get implemented inside of that. So.
Mm-hmm. Let's talk about credit a little bit for a second. Do you see changes in available credit impacting your investment theses? How much of your investment approach is dictated by the current availability of credit, or do you view that there's underlying trends in credit that will then create more investable opportunities for you?
Sure. So I can tell you a little bit about what we've done in the alternative lending evaluations that our firm has conducted to date. So we do believe, and this is an area I credit regulators, that there are probably, given the amount of data that's been generated on the consumer, if analyzed appropriately, there are better ways to underwrite people than just the FICO score. Mm-hmm. I think the FICO score has a number of issues with it, and regulators are embracing other data points that can also be indicative of consumer creditworthiness. Why that's important is it trickles down the entire value chain of, if an individual wants to buy and get out of a rental situation, how can they be underwritten if they have a shorter credit history or not as much of a down payment? So we have seen a number of businesses that are focused on, can we use alternative underwriting methods to assess borrower credibility, or can we offer different types of financing products that may be more appropriate for a consumer? For years, the mortgage, the really 15 to 30-year mortgage, was the bedrock of how we thought about consumer finance on the single-family home. And then there, in the last crisis, preceding that crisis, a number of newer mortgage structures came about that probably weren't as risk prudent, where you were looking at what would actually happen in different rate environments. So we are now seeing a good confluence of businesses focus on, are there new types of financing products that we can offer that better tailor into what our consumers can accept and can work with. I think from the venture standpoint, what we have to be cognizant of, given our limited partners, is, are there good places to make investments that have an impact and generate returns for our limited partners? The financial investing and fintech investing space is amongst the most competitive. Banks are participating in it, and it's very difficult for a small emerging business to compete everywhere. But we do think that there are good areas to compete within that, and so we're focused on backing businesses in that space.
Yeah, we've got a couple companies, I think, that have excuse me, that have looked at that too. LeaseLock is a reinsurer that's helping renters move in with zero deposit. So if you're here in San Francisco and you have a thin credit file, as we talked about, $50 million, how's 6 months of security deposit going to sound for you to move in? And so it's cost prohibitive for people to do that. So I think that's one way to sort of address it from a technology and an insurance standpoint, to say there's an alternate way to get you into a space. And so that's one. Nova is another one that aggregates credit bureaus from all over the world and then normalizes that to a FICO. And we know FICO's not perfect. We talked about ultra FICO earlier, but at least giving most of the immigrants, there's 2 million coming a year that are even from Canada and from China and from India and these places, then having to come up with 6 months, that puts you, especially in markets like Seattle and San Francisco, puts you at a real disadvantage to get in, and a frustration to get in, and then you're sort of waiting, and you'd have to go somewhere else or figure something out. So there are ways and companies that are looking to attack that space, and we're really getting behind how do we give options for people that fit into those either no credit overseas to get into homes and rentals.
So we think about credit in a completely different way. We don't look at opportunities to rethink, individual persons' credit and how that might impact solutions. It's a very big space, very interesting. But we actually reimagine credit by thinking about the assets themselves. Now that things are more quantifiable, thanks to data being shared from both individuals and from things gathered by IoT and sensors, et cetera. And thanks to automation, really, buildings themselves they've always had their own lives, but even more so, they have their own behaviors, and in some cases can share intent. And so we have a few investments that plays off of that thesis of the assets themselves having varying levels of credit worthiness. One is RentLogic that rates individual apartment units based on 311 data and a few other measured metrics to determine a letter grade rating as to whether this is what quality of livability is this unit. So as a renter, you don't have to just rely on written marketing material and pictures or sort of biased Yelp reviews. You can actually see what an unbiased algorithm suggests is the worthiness of your dollars, and for the banks that are underwriting the buildings, the credit worthiness of the landlords and the developers to create rental housing stock. And it's already showing improved behavior in New York, where they're currently deployed. They're deploying to a few more cities now. And another way we think about this is Pearl Street is another company we've invested in that looks at the other layers of the cost of living stack, mobility, energy, also housing supply, and again looks at what are the quantifiable elements of these assets that we can determine, not based on the end user's credit worthiness, but the asset's credit worthiness that we might underwrite, getting more of these out into the world for people to have access to them at an affordable level.
What I think all three of us would agree to is that there's little to no reason technology should not be playing a role in this space, right? There's almost no advantage to what the status quo offered. Paper processes, things were lost, unfair underwriting, not data-driven. And so what we're, I think, most excited about as part of being in this ecosystem of real estate tech investors is there are better ways to build businesses and offer consumers value propositions. And so what we look at is we think the future is sort of very bright in this space specifically.
Yeah.
And I think that's the same pattern of disruption we've seen in many other industries and technology. So if you're looking into your crystal ball, do we have an emerging Amazon of the equivalent of Amazon in retail in real estate today? Do we have those small companies that you think have the potential to grow and become large disruptors over the next 5-10 years?
Sure. I think you're going to hear each one of us talk about our favorite portfolio.
Your favorite portfolio company?
No,
We'd love to hear that.
No. So one business that I spent quite a bit of time with and really admire the leadership of, as well as the mission, is Opendoor. So Opendoor is looking at reducing the costs of the residential transaction process by creating a marketplace where the firm will buy from sellers on an accelerated basis, give people the ability to sell a home, whether they're going through a life event or the like, and then they're responsible for improvements to the home and then selling it on the other side. That business has grown meaningfully to date. It's the largest competitor in the space, has really taken a share in what will be north of 20 cities by the sort of mid-half of 2019. And what you're seeing with their business is the early network effects that characterize businesses like Amazon, where you get economies of scale, you get power in the business as you aggregate more and more data, and it creates data gravity. So what we were very proud to do specifically with Opendoor is partner them with Lennar Corporation, one of our anchors, to launch a trade-up program where Lennar homebuyers could actually sell their old home equity to Opendoor and then enter into a new buy with a Lennar home. And what that allowed the industry to do was really participate in the next Amazon. Like, imagine how great it would have been if the big retailers of the past had, instead of trying to fight Amazon tooth and nail, had enabled their business and participated in the upside. So we look at Opendoor as one of the clear winners in the real estate technology space, a business that we're proud to back, and also one that we feel the real estate industry has been able to embrace and help really grow.
I'm going to take that from a different point of view. So if I say, what does Uber or Lyft mean? So sort of on demand, and can there be on-demand housing? I think the answer is yes. I know the answer is yes. So we have a charity in the portfolio called News Story, which we may have heard of, that's going into disaster-ridden areas and building stick-built homes for $6,000. And we think, yeah, that's great. What's the next step? And so a company called Icon, which is their partner. So this year, if any of you are at South by Southwest, they 3D printed a concrete 850 square foot home in 24 hours. So to me, that's the Uberization of homes, where you can go in, and this is concrete. This will go into areas like Haiti after the earthquake, or Guatemala, or places where you have hurricanes. And so to me, that's a really cool disruptive technology that's really about the on-demand, that's serving affordable housing. Better Homes and Gardens is doing a whole community through News Story, and we'll use this technology to really sort of help the unfortunate that can't own homes. They're building these homes for $4,000, and so that is affordable for everyone. And so I think when I think about on-demand, how about on-demand housing, right? How about push button, get home 24 hours? And I know it's a little far-fetched, but I think that's really a cool thing that we're really excited about.
Yeah, maybe not Amazon, but definitely I think RentLogic, the ratings for apartment units, is the next Yelp for housing, or Walk Score for housing. I think it has the ability to scale to that or more, since housing is a core fundamental concern for folks. More closer to the Amazon side, I think the housing equivalent is like Star City is a company in our portfolio that's co-living housing projects, but the long-term vision in one of the projects they're launching now is vertical cities. Right, and so if you're able to create a branded experience similar to WeWork, or dare I say Apple, and you're able to provide a platform for all sorts of other innovations to be introduced, I think they're onto something very transformative.
Amazing. So I think with that, we'll go to questions from the audience, if there are any. Please feel free to submit questions through the website that's listed. I hear that they'll show up on the screen if there are any questions from the group. So maybe we'll give people a minute to do that. All right, first one. How does housing cyclicality factor into your investment theses? Home values are strong and have risen, but what happens when they fall?
Yeah. So I think I addressed that one sort of earlier. So our thesis is go broad. Find companies that are solving horizontal challenges, and if something is very insular, then we tend to pass, even though people will look at Moderne and say, your real estate fund doesn't necessarily translate into our thesis. So I think if you can find companies that are solving broader challenges, whether that's through machine learning or marketplaces, AI, you sort of throw in buzzword, big data. They're solving these challenges. Can they be applicable to real estate? And if you can find a real estate angle, usually disruption happens to the industry, not from the industry, is what we say. And so that's part of our thesis. So find these companies, and they could be big companies, that are doing stuff completely different. But if we can talk to them and find the applicability, and we can bring them to the space, I think it's going to help the industry as a whole move forward, instead of all of these sort of incumbents trying to solve these little small niches. And then if housing prices fall, again, they have revenues in other places.
Yeah, no, I think it's a very thoughtful question. It's one that we spend a lot of time on. I think what we've centered around is the real risk in the businesses in which we invest is what we like to call this double negative convexity to interest rates. So in the tech investing business, you're both exposed to interest rates from a valuation perspective. As rates go up, growth businesses tend to do worse than value businesses because of the growth profile of the cash flows. And in our businesses, we also have revenue exposure. When rates go up, there are fewer mortgage applications, home prices fall. So we very much focus our underwriting on how can we minimize our downside protection and participate in the upside of a potentially strong franchise business. And there are different ways of analyzing that, but looking at the downside through a cycle is core to what we do, because I think the only thing we know is that there will always continue to be cycles. So the only thing I can guarantee the people here is there will be another cycle. And so if you're not thoughtful about how you're managing your investment exposure, you can find yourself hit from both a valuation perspective because multiples trade down, and a revenue standpoint where your businesses aren't able to sell as much product to the real estate market.
I'll be quick. Simply, we're less concerned about the fluctuations of housing, of home values per se, and more the supply and demand dynamic itself. And we're big believers that population growth will continue, urbanization will continue, and so we're going to have to continue to innovate on how we build the housing stock to make sure that people can live comfortably.
Great. Second question. You all started to touch on some examples of this, but at a high level, how much are you considering a business's social impact when deciding to invest? And when it comes to housing, what does that look like?
I can start.
This is your core.
Yeah. So I mean, when I think about social impact, I guess you could call the real thing to ask yourself is there a problem that is here's a better analogy. In innovation in venture, there's a saying like either you're building a vitamin or a painkiller, and you definitely don't want to invest in just vitamins because at some point people just move on, right? You want to invest in painkillers. And so when I think about social impact, more often than not, this is a painkiller. This is a thing that needs a painkiller, not just a vitamin. Although a lot of the solutions to social impact, a lot of the proposed solutions to social impact tend to be vitamins versus painkillers. But we like to look for things that are going to go to the core of the pain and try to really solve that. It's not easy in social impact. There are a lot of stakeholders, and the real needle in the haystack is who is feeling the most financial pain and is willing to exchange value for solving this problem. And so we don't shy away from impact. We look for impact where somebody is feeling financial pain, and fixing this problem represents a transformative shift in an industry.
I think social impact's big, and I don't know that we necessarily go out and look for it, but when we see it, it's part of the thing when we looked at sort of, from the investment team, does this have a social impact, and what is it, and how is it going to help the consumer, and how is it going to help our partners and our investors? I mean, it's nice when it's there. I don't know that, to be honest, that we go out and definitely look for it, but I think the social impact that it has is we're always looking for things to make it easier to buy a house, rent a home, and so that all has social impact to it. And so, if we can solve that problem, then that's going to be the social impact, that we can get people into homes quicker, faster, with less money down, and those type of things.
Yeah, and I think both of them did a great job of touching on this. The powerful businesses and the sort of franchise businesses that emerge in the real estate space will have to create great experiences for consumers, right? And it's very rare that you've seen really thoughtful and strong technology businesses not create delightful experiences. So I think that's one level of impact, which is, are you giving the consumer a much better experience than the status quo? And I think on the second level of impact, on the social space, whether it's businesses like Lime that are creating programs for individuals below certain income levels to be able to ride their scooters and their bikes at a reduced rate, we encourage that. When it's good for sort of the social impact, it adds to the business. We're happy to encourage that. But I think what's nice about the real estate space is there's so many layers of inefficiency and bad consumer experiences. You can have quite a bit of impact by just creating a delightful experience.
Yeah.
I'll add one more thing. When we think about impact and we think about companies' growth, we like to find opportunities where the growth of the company, meaning sales or transactions, has a one-to-one equivalence to the impact that they're having. every customer or user is creating some unit of impact. So we don't have to look at it separately or look at soft metrics around impact. But then at the same time, we also look for opportunities that have nth level of impact in that you're solving a transportation challenge. You're not only lowering, or a water efficiency challenge, you're not only lowering somebody's cost of living, you're also lowering the collective water supply demand equation. You're increasing water safety, et cetera, et cetera. We look for opportunities to actually have reverberating impact, but from a core stone that is equivalent to business growth, right? So we're a for-profit venture fund competing with Moderne, Fifth Wall, Andreessen, Sequoia, and the rest of them.
Or partnering with.
Or partnering.
Yes.
It's all a co-opetition in this industry. But
we can all hold hands.
But I firmly believe that solving big problems means you're a social impact company, whether you admit it or not.
Yeah.
I think that's great. So, closing thoughts. Where do you see the world in 10 years? Where am I going to be living?
Oh, boy.
Well,
Vic, I'll let you go on that
yeah,
one first.
Yeah. So, look, I think in 10 years, what I know will be true is technology will permeate the vast majorities of industries, and there's no reason real estate will not be at the top of that list. I said it previously. It's the largest class on earth, largest asset class on earth, and amongst the most backwards. So I expect in 10 years we will have large technology businesses that won't actually be technology companies. They won't be looked at as technology businesses. They'll be looked at as the leaders within their sectors, whether it's a real estate business, a transportation business, a retailing business. I think we're going to continue to see cycles, and I think you're going to see the central bank and sort of the government play a role in ensuring that the U.S. remains competitive from an entrepreneurship standpoint. Entrepreneurship is the real bedrock of the U.S. economy. And so I think what we tried to talk about today on the regulatory side was how do we make sure small businesses can compete? If you continue to add tons of regulation in the next 10 years, you're going to continue to empower really large businesses that can comply. So I think you're going to see governments play a role in entrepreneurship. And I think, look, we're very optimistic people. We believe that if you look at the major innovation cycles that have taken place in the last 100 years, the world and the consumer has always ended up better off. And if you look at the cycles between where individuals started their life and where they're ending, you've seen tremendous improvements in the quality of life, which we're very dedicated to investing in.
Okay. I think to look forward, you sort of have to look back a little bit, and we say, sort of 10 years ago, I was in the midst of the crash in secondary markets, and so the world's falling apart, and our founder is starting a real estate tech fund. And so, I think we sort of look to the past. A couple things is that, when the internet happened, I feel like we're at this inflection point. Like when the internet happened, business came on, we're like, oh my God, this is a thing. Like I feel like we're at the this is a thing, I have to get on it. I'm sure we can all say now people are knocking on our doors instead of us looking the other way. My hope is that, the future is, the tech is here. I hope that the companies in this space and just embrace it and do something now because it's here and it's coming and it's a tidal wave. And so, I hope in 10 years from now, businesses are just much more open to the tech and embrace it because it's here and it's going to stay and it's coming faster and faster. So
I always say I don't have a crystal ball. I'm a venture capitalist that's not in the business of predicting the future. I can only hope to be lucky enough to meet the visionary founders that are building the future. So I can tell you where my money is and where I put my LP's money. So in the future, you'll walk into an apartment that is a vast open space of mostly your art and things that you like to do on the ground. And when you want your furniture, thanks to Bumblebee Spaces, it'll come down from the ceiling. And if you want to completely change where you live, you don't have to move to another geography. You can completely change the interior to give yourself a feeling of being in a new home, thanks to social construct. And the concept of the city you live in will both mean where you are geographically, but also which star city you're in. So that's what life will be like in 10 years.
Amazing.
Just a small piece.
they're all going to be his company.
Yeah, they're all going to be companies. So.
Welcome to Stoney World. That's
I'd like to thank each of you for participating today.
Yeah.
So.
Thank you, Alicia.
Thank you. Yep.
Thank you very much.